have Rajat Bhattacharya, who's a senior investment strategist from Stancy, joining in to discuss the whole host of global cues that we have to work with. Rajat, hi, welcome to the show. If you could just start by giving us your perspective on the US banks and a possible downgrade from the rating agencies. How serious is that?
Hi, good afternoon. That was the big fear yesterday, and it is they are under pressure from regulations. They're under pressure, as we know, from March onwards. We heard that the story about the investments into property sector, the commercial property sector, that is, and then you have the investment into treasury bonds, which have lost value, right? So there's a array of risks facing these bonds, the sector. However, I must insist that the larger banks are well capitalized, right? So the problem is not with the larger banks; they are well capitalized, and there is less pressure on them. The problem is with the small regional banks, and they face the real pressure there. So overall, this is part of the issue. The main problem, of course, is in terms of where inflation goes and where the Fed policy goes. And there, I think we are looking at a place where Fed is more or less done with rate hikes because the economy is slowing, the job market is slowing. Yes, they are still tight and wage pressures are on. And tonight's Fed minutes are going to show some more signs of where the Fed is. But I think if the Fed is largely done, then the pressure on rates going higher are less so, and that relieves at least some pressure on the banks.
Okay. So, Rajat, you don't think that a possibility of these downgrades coming in from Fitch or the one that came in from Moody's last week is a cause of concern for the banking industry? Because Fitch also said JP Morgan could also be downgraded. So do you think this was par for the course expected, or this is something which could continue to impact US markets?
Yeah, on the last week's rating, again, we knew that they were looking into it, right? And they had warned us. It was on watch. So it's not a huge surprise on the last week's sovereign rate cut. We know the situation, the fiscal situation in the US, and that has worsened this year because of low tax collections. But, and we know the trajectory, the US debt trajectory is going to rise from here. And the fiscal deficit situation is stressful, but that in itself is unlikely to be the driver of markets, and the same goes with the bank ratings. As I said, I think the overarching theme is where inflation goes, and a lot depends there again on where the labor markets are, and increasingly there's this near-term risk of oil prices rising because of the geopolitical disruptions you saw with Russia, with Saudis restricting supplies. So that adds another element to that inflation, near-term inflationary surprise shock. But those are the things that are really going to drive this market, not so much the rating decisions of for these banks or the US sovereign.
Okay. Rajat, how would you approach the Indian markets now? Because in the past 13 odd trading sessions, 11 of the 13 trading sessions, we've seen the FIIs in fact sell in the cash markets. Do you think that FIIs are lightening their position right now in the Indian markets, and how would their approach be?
Yeah, the Indian markets are actually in an interesting phase. When we last spoke, I think a week or two ago, we were talking about time for consolidation, and that consolidation did happen, as we saw. Anyway, Indian markets were a bit overvalued, and it's were stretched. Now that this correction has happened, this consolidation has happened. They are not so stretched anymore in terms of the technical matrices that we see, but we always, we have been insisting is that Indian markets have the structural case now for for the long-term story is so good that the FIIs are thinking more long-term, more structural. So yes, short-term, we've seen the consolidation, but I would say that any 5 to 10% dip makes brings back the structural story for India. And there, India is the one market which is going to deliver growth, is expected to deliver growth over the next 5-10 years. Earnings growth, GDP growth, and the return on equities remains high. And those are structural drivers. And what that means is that you refer to FIIs, increasingly foreign investors are thinking about whether they need to put more higher weightage, structural weightage to India. If that happens, and that is not going to happen overnight, but people are waking up to this long-term story, India story. If that happens, then India, in that case, is underweighted in a lot of foreign portfolios. And so you do have a good long-term story, and these cases of consolidation only gives them the opportunity to add more to India.
Okay, so that's about India. You've been bullish on the Indian story for a while now, Rajat, but what about China? Because we did see the surprise rate cut come by. We've seen the macros not looking so good. Do you think this rate cut was enough, or at least a start to see that economic activity come back? And in terms of valuation, it's way cheaper than the Indian markets. Do you think that is one reason why we could see an up move there?
Yeah, they did cut rates for the second time in the few months, right? But there's more to be done. The main issue in China is lack of confidence, both domestically and internationally, in the economic story there, right? So China has been trying to deleverage, and as a result, now that the growth is slowing after that initial recovery after the post-COVID, they are trying different measures. The property sector is the big overhang there, and that is not going to go away. So they are trying to re-stimulate or at least stabilize the property sector. And we saw issues with one more property company in the last few weeks, creating further pressure. The Country Garden has delayed payments, for instance, and that it creates an overhang. So to answer your question directly, they are trying to do more. Is that enough? I think we need to wait for more. They need to deliver more stimulus for the property sector, for instance. They need more targeted stimulus for domestic consumption. They are doing all of that, and markets are indeed cheap. In fact, the Chinese valuations are half that of global equity valuations. So that makes it interesting, but we need to see more there for people to invest long term. That confidence needs to come back.
Okay, all right, Rajat, that point is taken. Thank you very much for joining in and speaking with us and giving your perspective on the global markets. For us, we've seen a significant recovery, and that is continuing for our markets as we speak. So the Bank Nifty is down around 148 odd points only. So the intraday chart will tell you more. There's definitely buying which is coming in at lower levels for the Bank Nifty. Take a short break. Up next, we have our special segment, Mid Cap Spotlight, where we will put the focuses on packaging companies that are moving in trade on the back of a news update. Stay tuned.